insurance advisors. You've done it for a very long time now. Your role is very different.
So some of the benefits looking at the life insurance as part of the portfolio, especially in today's environment with their small business owner.
Right. Because, corporately owned policy, the death benefit is paid to the corporation. It can come out from the capital dividend account to the family.
One of the greater benefits is the dividend, right? The cash value can go over time.
What a wonderful podcast with Wai from Sun Life. Wai has so much knowledge about products, about how this product should be structured, what should be given to what kind of a professional, and why they should have it. What a great podcast. I loved it, and I think you will love it too. Welcome to Simple Wealth Wisdom Podcast. I'm your host, Gakhar. Each week, I bring simple financial security ideas for successful business owners and professionals like you to help you build and maintain your lifestyle and legacy. As I work with business owners and self-employed professionals, I see a lot of them are always looking for tax advice, accounting advice, legal advice, estate planning advice, and investment advice. This is the reason I started this podcast, where business owners and self-employed professionals like you can always go and get the ideas and answers to your questions regarding how you can protect and grow your wealth in the most tax-efficient manner. Being an insurance and investment advisor myself, and very especially working with business owners and self-employed professionals like you, I feel each guest will bring a lot of value to you all. And today I have Wai I from Sun Life. We joined Sun Life in 2014. He comes with over 2 decades of experience in insurance and financial sales management. Today, his role is Regional Vice President for Sales and Business Development, and he works with advisors like me and team at Sun Life. I love one of his favorite sayings and the rule that he lives by, which is, what you share, you multiply, and what you hold, you diminish. Wow, so rightly said. I love that way.
Thank you.
He brings this collaborative spirit to his work every day. He's a passionate and positive leader who builds long-term partnerships, trust, and respect. And by working together with advisors and sharing and collaborating on best practices, he helps advisors grow their business. He's proud to be a part of a strong team of Sun Life support and advanced case specialists who work alongside him as he helps advisors grow their business. Wow, this is so exciting. And I'm very happy to have Wai with us here today as he's going to share his knowledge directly with you all. Coming from the career side, as I mentioned earlier, he helps advisors, but on this podcast, he's going to answer the questions which many of you business owners and self-employed professionals that have asked me. So now you're hearing directly from an expert with 2 decades of experience in the business. And again, welcome, Regional Vice President with Sun Life.
Thank you, Sim.
Thank you so much for coming here, Wai. I'm going to ask you a few questions which my viewers really want to hear, and I thank you for answering them to them. Since you're a part of insurance company and you deal with insurance advisors, you've done it for a very long time now, your role is very different. Why do you think insurance should be a part of every business owner and self-employed professional's portfolio?
It's a great question, Sim. As we dealing with lots of business owners across Canada, and there's always a need to make sure they have the right portfolio, particularly in the licensure portfolio. How that going to work is, for example, let's look at the risk management.
Yeah.
Right? Estate planning, tax planning, as well as the preserve the capital is very important. Estate value of the value of the planning, and the other important factor too as well. What about the income tax liability planning, right?
Right.
And also think about the cash value growth within the organization that really helping the corporate environment situation, and also the capital tax free go through the shareholder having the net proceed of the life insurance against ACB, adjustable cost basis, will go turn into capital dividend account.
Mm-hmm.
So those are some of the benefits looking at the life insurance as part of the portfolio, especially in today's environment with the small business owner and self-employed people in Canada today.
Very rightly said. As we explained it a little bit in the technical language, because I know one of my viewers might not understand what ACB is, adjusted cost base, what CDA, capital dividend account is. So maybe we'll make another podcast on that, explaining that. But he said very rightly that people think insurance is just death benefit. It's not only death benefit. People know what insurance is, but they don't know what insurance does. And I say it in every podcast that insurance has a lot bigger benefits: tax saving, growing the retained earnings, retirement planning, estate planning, succession planning, continuity planning. All this can very well be taken by insurance if it is a part of portfolio. So thank you so much for sharing that way. As a lot of businesses are started in partnership, nobody has made it to the top alone. People really start and then the businesses grow. And a lot of businesses start in the partnerships and then the partnerships grow. And when the next generations join the business grows to another level. There are different kinds of partners now. So how insurance can play a big role in terms of shareholders agreements, because it's not only one person. Now there's different generations in the business, or different partners, different brothers, different friends. So how do you think insurance can help?
Yeah, I look at, I try to be simple as much as you can. If you look at the shareholder agreement, number one is, in a life of event, there's a lot of things happen in our life. There could be a sudden death,
Yeah.
right? There could be illnesses, and there's also this disagreement among the partnership, right? So life insurance is shareholder agreement is really helping position ourselves in those situations, as well as business continuation, as you mentioned earlier,
Yeah.
right? So you want to maintain the business continue to grow and nothing to be disrupted. And last and not least, number three, what I would say that, as I mentioned a little bit earlier, is the estate value preservation. So if you look at those three areas, shareholder agreement is very important in today's societies.
So if you just want to say a little bit more about these things, are all very important, but how does insurance help all these? What can insurance do? If somebody has a shareholders agreement, somebody gets sick, or there's a death of a partner, how insurance can help?
Yeah, definitely. If the life insurance, the life proceed will pass through the shareholder, right?
Yeah.
So the shareholder have the right to whether to buy out the other shareholder.
Yeah.
That's very important, right? Or the other partners. So because at the end of the day, different partner might not want to have a spouse to be involved in the with the company,
Yeah.
or family member to be involved in the company. So having that life insurance as a proceed to fund through the ACB, fund through the capital dividend account. So this way you have a full control of how do you want to dictate how the business you want to run, whether you want to buy out to the shareholder or you want to continue with the partnership with the partnership with the spouse or the family member. So you have the full control of how you want to determine how you want to go with your businesses.
That's right. And there's so many times I've come across people who've got the shareholders agreement, but they haven't funded it. They haven't signed it.
That's right.
This is really something. And, when you are working with a partner, you both get along so well. And one day the partner, something can happen to anybody, partner dies, and partner spouse does not know anything about the business, and maybe does not want to work with you, or you don't want to work with the business. So as you said, the insurance policy will pay to the corporations, that money can be used to buy the shares of the deceased, and then you can replace the person who's gone, and you don't have to deal with the conflicts or deal with the widow or the surviving spouse if you do not want to work with. So insurance can play a very, very good role. And that is something I really feel that self-employed professionals, business owners, if they have a partnership agreement, they should definitely plan something like that. So thank you for sharing that, and that's a very important part. Now, buying a policy, very important part. In the corporation versus buying personally owned. So many times they say, you know what, I bought a policy, I was 25 years old, I have a policy for $2 million, now I have a business, but there should be a policy in the business too, in the corporation too. So, what do you suggest? Buying a policy in the corporation versus buying personally owned. How do you position it in terms of tax implication? What should most business owners and professionals know when they're buying a policy? Where should they position it and why?
Yeah, it's a great question, Sim. So when you think about the corporate-owned life insurance versus personal-owned life insurance, as you know, in Canada, we have a great advantages having a corporate-owned businesses they're paying a lower taxes versus a income
Yes,
taxes,
yeah. Mm-hmm.
right? As you know, so for example, somebody making $250,000 versus corporate-owned businesses, you're paying 50% on the corporate-owned personal taxes.
Yeah.
On a corporate, you might maybe be paying 12.5%,
Yeah,
right?
that's right.
So that's a tremendous tax savings on the life insurance side. And secondly, you buy in bigger policies using the same amount of dollars.
Yeah.
And over time, the compounding of the saving over year is substantially, right?
Yes.
And secondly, the cash value growth is tax-free within the life insurance policy, tax exempt,
Yeah.
right? And would be tremendous bigger than the personal owned.
Mm-hmm.
And last but not least, that state value of the life insurance, corporate owned life insurance growth versus personal owned life insurance would be substantially much higher, having being your own corporate owned life insurance versus personal owned life insurance.
Absolutely. And also, if you can just share a little bit that should they have both or should they only have corporate? Because, corporately owned policy, the death benefit is paid to the corporation. It can come out from the capital dividend account to the family in the tax efficient manner. But again, it doesn't replace the personally owned policy. If you have your loved ones, you've got your kids, and you want to have a personal policy, great idea. But once you are a business owner or a self-employed professional, buying a policy in the corporation is a great idea as well. And
Yeah, so I totally agree. I think we should look at don't put everything on one basket, but think about what is your corporation worth. So
Yeah.
that's the need that you should buy for your corporation, and the rest you should also invest it into a personal owned life insurance to protecting your loved one. And
yes.
so this way you both win either way.
Yes, that's a great thing. And getting to know what your corporation is worth or what is your tax liability going to be when the shares are going to be transferred to the next generation, if there's done any estate freeze. So there's so many things that you can look into it when you're positioning the policy. Now, the different kinds of products insurance companies have. There are so many products, term insurance, universal life, whole life policy, and we always say that if you're looking at long term, it's a good idea to buy a whole life policy or universal life policy, which is a permanent product. That means even if you die at age 100 or more, the death benefit will still be paid out. Now, the question is that is there, because the whole life policies have the cash value, there are dividends coming into the policy, there's an extra benefit that they can draw the money from the policy. I would like you to share with them, if someone buys a whole life policy, how can they take out the cash value from the policy? And if they take out the cash value from the policy, is there any tax implication on the withdrawal? And after that, once you answer that, my next question to you would be, what is the best way to take out the money from the policy?
Okay.
So 3 questions in one way.
Sure, no problem. 3, 2, 1, right?
Yes, absolutely.
Great question, Sam. So as you know, with the whole life insurance policy, one of the greater benefits is the dividend, right? The cash value can go over time.
Yeah.
With the whole life, particularly with the participating whole life insurances, the cash value giving out each and every year, they are vested.
They're vested.
Okay, so that
let me explain that,
sure,
the meaning of
please.
vested.
Yes.
Vested means whatever is given to you cannot be taken back. You can only go up from there. If the cash value is, let's say, 100,000, the next year, even if market crashes, anything happens, it can never go down. That's called vested. And that is the term we normally use for whole life policies. Am I correct, Ray?
That's correct. Thanks
Yes.
for answering that, Tim.
Yeah.
So as once the policy is vested, so that means it accumulate value over time
Yeah.
and become tax-free.
Mhm.
Now the question is, what happens is if there's an emergency, if I'm going with the corporation, I want some revenue coming in, or if I'm thinking about retirement, what should I do? There's a couple of ways we could do it, right? We could use retain earning, we could use our saving from our RSP, but however, one of the advantages that we could use for the whole life is a couple ways we could take the money out from the
Mm-hmm.
cash value. Number one is withdraw. So when you withdraw the money, that might be some tax implication
Okay.
against your cost of insurance, right?
Yeah.
So that might be one possibility, but withdraw is very straightforward. If you have $100,000 there, I take out 50,000, but $50,000 depending on the cost of the insurance, you might not pay taxes on it, or you might pay taxes on the gain of the cost of insurance,
Yeah.
right? That's
Right.
one way. And second way is a policy loan, which
Mhm.
common to you could apply for a policy loan with any insurance carrier. With Sun Life, is very straightforward. You could turn around within 48 hours.
Yeah, I've
Very
done that many times.
straightforward.
Yeah.
The loan rate is very simple. It's prime plus 2.
Okay.
So that's loan rate. So basically, again, that's a very, very efficient way to do it. But however, when there's a policy loan, there might be a cost of insurance might be adjusted. So in other words, might be a tax implication.
Mhm.
Okay. So you got to
Even with a policy loan.
even policy loan.
Okay.
That's right. Okay. And last but not least is the collateral loan.
Mm-hmm.
Collateral loan means you could use a third-party lending institution to against your cash value.
Mm-hmm.
So this is probably the most advantaging having a corporate-owned life insurance using a borrowing from the corporations.
Mm-hmm.
So the money will go to the corporation. The corporation could give it to the shareholder or whatever. If the corporation wants to buy equipment or with helping the shareholder buy equipment, and they could do that. And the advantage of the corporate loan, collateral loan, is that number one is that could be non-tax. The tax, you don't have to pay taxes on it. Okay.
Yeah.
And then the interest can also be deductible
Yes,
as well.
it can be that.
And then last but not least, the cost of insurance also can be deductible too as well, depending.
NCPI, yes.
Yes,
Yeah.
and depending how long the policy has been enforced and so forth. This is some advantages of using a collateral loan. When you're taking the money out. So that's one consideration. However, always nice to talk to your tax consultant about it to make sure what will the best solution for the corporation.
This is wonderful. So just to summarize a little bit, I would like to say that as we mentioned that there are 3 ways to take out the money from your policy cash value. The first one is simple, taking the money out of the policy. So to give a little bit of example on that way, if somebody has 100,000 and they're taking 50,000, does the death benefit reduce because you've taken the money out of the policy as a simple? Is that called the surrender of the partial surrender?
You're talking withdrawal?
Regular withdrawal. Simple.
Oh, regular withdrawal?
Yes,
No.
it's a partial surrender.
No, there's no. Once you withdraw the money, that's go against your cash value of the policy.
Okay.
Right.
Second way, what we mentioned was that you're taking a policy loan from the insurance company. So you got a policy from Sun Life or any carrier. There is $100,000 cash value. You can tell them to give you the money. 48 hours is the turnaround time. They give you the cash against your policy. And again, normally the money that you take out as a loan has interest that you have to pay for that, which could be prime plus 2. This is just like something like you buy a house and you have equity in the house, and when you borrow against the equity from the bank against your line of credit, you pay the interest on the borrowing amount. The difference is that there you have to return that money back. Here you don't have to return that money back if you don't want to. It can be deducted from the death benefit.
That's
Am I correct?
exactly.
So that's another advantage. And the third thing what Wei said is the best and the most efficient for the business owners and most people is that borrowing from the third party lender. And there are so many lenders in the market, you can borrow it from them. Their interest rates are also comparatively cheaper, I guess. Sometimes there are some comparative ones, but again, when you borrow from there, you can deduct the interest, number one. And number two, you don't have to worry about the tax implications, because then they can you can borrow personally or you can borrow corporately. So thank you so much. That was wonderful. That is something very useful. Now, I move on to the next topic. Again, my favorite, business owners and self-employed professionals. They're all self-employed. There's no employer to them. They are their own employees. And now they're not going to work all their life. The time is going to come when they're going to retire. So what is your suggestion for them for retirement planning as they are their own employers? Can insurance help in retirement planning? Is there any policy structure they can have it in their corporation to plan their retirement?
Yeah, I think with Sun Life, there's a lot of strategy you could really have planning for the retirement plan. As you know, a lot of corporation thinking about yes, there is RSP as a saving tool. That's number one,
Yeah.
obviously, and they could also take out the money from their retained earning. That's another additional source of income coming
Yeah.
in, right? That's
Yeah.
very common for. And then the advantage of life insurance is, there's advantage of using what we call corporate retirement strategy.
Yeah.
What that means is, when time for retirement, as I mentioned a little bit earlier, you could collateral your life insurance policy to a lending institution using that money to supplement your retirement income in the future when you decide to retire. So that's a great advantages. For example, let's say you have $500,000 there in the cash value.
Yeah.
By the time you turn 65 or 68 or 70 years of age, $500,000 you want to take out, $25,000 a year, right? That's
Yeah.
over 20 years time. That's a great supplemental income. That's number one, is non-taxable.
Non-taxable. Yeah.
And that's another fact, your other benefits that you have, your CPP or
Oh, yeah.
OAS.
They're not getting affected.
Exactly, right?
Yeah.
So that's a huge opportunity, and the cash value continue to grow anyway. So upon death, upon death, the estate value go to the shareholder estate, right? Net cost of insurances against the adjustable cost base, and go through the capital dividend account minus your outstanding loan, and that goes to the shareholder estate. So once again, wonderful strategy, very common used today with the small business owner.
Very good strategy, and I love that too, because I'm also a self-employed professional, and I really feel that is a great thing, because you don't have any CPP or something that you're going to have a pension from your work. You're your own employer, so great way to grow your retained earnings, or buy a policy and the money is growing in it. Instead of taking the money now, you're taking the cash value from the policy, whether you're taking it from the insurance company or third party lender. You're taking it during your retirement time. And when you take out that money at that particular time when you're not working, this is not affecting any other benefits. You're not getting into the tax. It's not increasing your tax bracket at the time, because again, you're taking the money as a loan, and that you don't have to ever return because it's going to be deducted from the death benefit. So what a great benefit. Your cash value in the policy is growing tax free. You have more money that you can take out. And then at the same time, it's not even affecting your tax benefits at the time. You're paying less tax, and there'll be a tax benefit in the end. So this is something wonderful. And now I just want to ask you one more question. I know we're running out of time. We want to have you, as I always say, that time is always short. We need more and more of you here. As age grows and business grows, somebody new in the business, when you grow, gray hair, businesses go to another level, retained earnings grow, tax implications grow. How can insurance work simultaneously, that they can this can take care of everything? They don't have to, because they might not stay insurable by the time everything else is there. And so what do you suggest? What do you think, any planning tips that they can do it while they are at this stage, so that when they reach here, it's taken care of?
Great. Like you said, time is running out, but I'm going to try to answer that question very quickly. Sim, as you know, you just mentioned, as everything grow, taxation grow, but in Canada or in the world, think about it, whether you are a personal, whether you're a corporate small business owner, or high net worth client, what do you think the major concern is to preserve the capital?
Yeah.
Right? The tax rate is continue to go up in Canada, and that's not going to change. So what is the greater ways to leveraging that is using life insurance?
Yes.
Is to preserve your capital, right? How are we going to do that as you retaining grow, your debt benefits grow, your business grow? So two ways to look at. Number one is as your business growth, you should buy more life insurance.
Yeah.
Right?
Yeah.
Okay. And how are we able to do that? Indexing of the value of your businesses. Think about, if your business is worth $1 million today, what's it worth in 5 to 10 years? Might be worth $2 or $3 million. So you should be looking at $2 to $3 million down the road as well. So there's a couple ways to
You can
really
do that.
fund your life insurance by planning ahead rather than waiting for today, because
Yeah.
everything's going to move up.
Everything is going to move up. That's wonderful. Thank you so much for sharing all that way. That was really useful. And this has been very informative, very helpful. And I think, as I always say, that whenever I sit next to you, I end up learning something. And today, again, I learned something great from you. And so, before I say anything, thank you so much, Wei, for coming here. It was a pleasure having you. And that was another episode of Simple Wealth Wisdom Podcast. Please let us know in the comments what you liked the most about this podcast, and if there is anything else you want to see or ask, and I'll make sure to bring that to you in our future podcast. Watch for us again next week with a new guest. Until then, stay safe and bye-bye.